Good morning. Good morning. Good morning. Today, today is Saturday, February the 21st, 2026. I wasn't really going to post no video today or anything like that. However, this is something that I think is very important. I am right now in a what they call a paper trading account on Thinkorswim. That's the one thing that I like about Thinkorswim is that they have a paper trading account. Tasty Trade doesn't, so you can't practice your trades or practice anything before um, using real dollars. That's the downside to to Taste the Trade. But anyway, so in this paper trading account, I have 100 shares of Nike. Okay. Now I bought the shares back about a week or so ago, and I paid $6,343 for those 100 shares. Right. And right now, the stock is at $65.37. So, um, if you multiply that by 100 shares, that's $6,500. So right now, I'm up about 200 and something dollars. Let's say about $200. Just nice round figure. Well, how do I protect that? Because right now the market is at all-time highs and it keeps going higher. Well, like I said to my dad this morning, and this is what made me want to create this video, was that, and it's nice that the market keeps going up, but eventually it's going to turn. There's going to be a downturn. And you don't know how nasty the downturn can be. It can be a mild downturn or it can be a real nasty downturn. So, how do we protect my shares of stock, my 100 shares? Just like if you buy a house, whether it's a primary residence or a rental, you will not buy a property without buying insurance. And if you buy a car, you'd be foolish to buy a car and not buy insurance. Well, if you're buying shares of stock, owning shares of stock, to me, I find that equally foolish to own shares of stock and not have insurance on it. Because insurance can protect you from loss. It can minimize your loss, or you could have what is called a guaranteed no loss. In this particular case, I could create really a guaranteed no loss because right now the stock is up about $2 from where I purchased it, on this paper trading account. So you would say, well, okay, Jermaine, well, how would you do this? Well, I will click on this Nike symbol. Then I'm going to click on option chain. Well, first of all, let me just move this to the side because you don't need this. Let me move this up. I'm going to click on option chain. Right. And then I'm going to go like, say, a month out. So that's going to be about what, 30 something days. You know what? No, I'm going to go to April 17th, which is 55 days away. Now, why 55 days? Because basically this is between 30 and 60 days. You want to, when I sell options or buy options, well, really, when I sell options, not so much when I buy options, but when I sell options, I want to at least go no further out than about 60 days. Now, sometimes I might go out a little longer, but mainly try to stay within that 60-day period. So what I'm going to do is click on this April 17th. So that means these contracts expire on April 17th. Okay, so this contract is good until April 17th. So, oh boy, no figures are coming out, so this doesn't help. Okay, I wonder why. Maybe it's because it's a Saturday and the markets is not open. Well, it's April 2nd. Okay, now, okay, there we go. April 17th. There we go. Okay. Now, remember, I own the stock at $63, right? I can insure my stock at 62.05, and I'm going to pay $315 or $3.15. See, $315. That's what I will pay to insure my stock, right? Okay. But now if I bought the stock at 63 and I'm paying $3.15 to insure it, well, I'm really paying for the stock $66 instead of 63 or $66.15 because you add the $15, the 15 cents here. So the goal, but I don't want to increase my cost basis in this stock. So how do I fix this? So I will go ahead and buy the insurance at 62.50, which gives me the right. I have the right. Let's say I own the shares at 63. I have the right to sell my shares now at 62.50. So let's say Nike turns around, because remember, 90% of your stocks is going to follow the market. So if the market goes up, 90% of the stocks in the stock market is going to also rise as well. Okay. However, if the market turns, 90% of your stocks follow in the downturn as well. So let's say there's a downturn and Nike falls all the way to $10, let's just say. Not most likely going to happen, but you never know. But so how do I protect my shares? Well, if I have the right to sell my stock, because I'm giving someone the right to sell my stock at 62.50, if Nike falls all the way to $10, I have the right. I own a contract that says I have the right to sell it at 62.50. So if Nike falls all the way to $10, I'm going to exercise this right and sell my stock at 62.50, which means if my cost basis is now 66 and I sell my stock at 62.50, I'm really losing less than $400, 500, I'm really out $500. But what if I decide I want to get this insurance for free, which means I don't want to pay for this insurance. Because remember, if I pay $315, I got to pay for that insurance. So how could I get the market to pay for this insurance without it raising my cost basis? Well, what I would then turn around and do is sell a call option, which means I am obligated to sell my stock if it gets above 65. Right now, it's above 65. So by April 17th, I have the right to sell my shares at 62.50 if it drops. But if the stock keeps going higher, now I'm obligating myself to sell at 65. So you say, Jermaine, well, why would you do that? Because now check this out. You see this $1.40? Well, I'm going to get paid $140. I click on review, or minus the fee. So $138. I'm going to get paid money into my account. So this $138 immediately comes into my account. And I have the insurance. Now, what does that 138, what does that 140 do? It lowers my cost basis from $63. Now, if you minus 140, because remember, let me just X out of here real quick. Again, let's go back to what the cost basis. Whoop, I messed up. Give me a second. See, I own the shares at 63.43. So I'm going to pull up my calculator. 63.43. So I own the shares at $63.43, right? Now I'm going to minus $1.40 that I bought that. Remember, I did that contract for. So my new cost basis would actually be $62.03. So if my new cost basis is $62.03, remember, I have the right to sell my stock at 62.50 if it drops all the way down to $10 or so, whatever price. I have the right to sell at 62.50. So I have the right to sell at 62.50 and I sell and so let's say I sell my stock at 62.50. Well, I actually pay 62.03. I have a profit, right? What is 62.50 minus 62.03? That's 47 cents. So that means I profit 47 cents or times 100 shares, that's $47. But what if the stock keeps going higher? So if the stock keeps going higher and I got to sell my stock at 65, well, guess what? If I have to sell at 65, but now I own the shares at 62.03, I make almost a $3 profit or $2.97 profit, which is $297 profit times 100 shares of stock. So this is what you call a collar trade because I already own the shares. So I'm buying a put for insurance because it insures the downside. Okay? That's what that put does. It gives me the right to put my shares to someone else, to the seller. That's called buying insurance. Okay? And then to pay for that insurance, I'm selling a call, which means I'm still renting out my shares. It's like a little rent, a rent to own. I'm giving someone the right to rent my stock out to eventually own it at 65. So I am protecting my downside. Now, if the stock shoots up to 70, 72, 75, whatever, I'm still obligated to sell at 65. That's the downside to this. But I don't care about the upside. What I'm trying to do is protect my downside. Because the last thing you want to see is that you pay $6,300 for those shares. The stock is at 63. Now it drops $30, $40 due to a downturn in the market. Though, again, I don't think it will do that. But again, you're protecting yourself in the event, just in case the market turns get nasty. You're protecting your downside. And guess what? You're still profitable. This is what the wealthy do. They buy insurance. Never buy an asset without insuring it. I learned that a long time ago. If you buy an asset, you want to insure it. Hell, even if you buy a liability like a car, jewelry, you want to insure it for just in case. This is no different. Okay? It's called buying insurance and you're protecting your downside. That's all this is. I want to thank you for watching this. Again, this is just, I'm not giving financial advice. I'm just telling you what I think this is something that I'm doing in my real account. If I own 100 shares of stock, I'm going to, unless it's a specific ETF or something like that, I'm basically where I already, like, let's say if I own like say the ETF of the market. Okay. Then to me, it doesn't, I could buy insurance, but the market's not going to go all the way to zero. And at worst, the market might go down 30%, but it's going to recover. So unless you're buying like an ETF of the market, if you're buying like let's say shares of stock of a company, you might want to, consider buying insurance to protect your downside because unlike the market, a stock can drop 90%. That can happen. Even a quality stock like let's say Nike is not, though it's not likely, but again, okay, good companies have been known to drop far in a market downturn. And the further it drops, the longer it takes for you to recoup your investment. Now, what you could also do when the market drops, so let's say that put option, so that put option that I bought, that insurance that I bought, I don't necessarily have to sell my shares. I can just simply use the profits of the drop to buy more shares, which will also increase my wealth that way too. So there are different strategies you can do. But let's say you're saying, you know what, the stock dropped, let me get out of my shares. This is a way to do it without losing your shirt, so to speak. So I want to thank you for watching this. If you have any other questions, you could always, text with me or email me and I'll get back to you. So I will talk to you later. Bye bye.